All right. So welcome, everyone. My name is Deanna Clark, and I'd like to welcome everybody to our town hall webinar, which is on selling your business, a primer for highly regulated entities. I'm here with Jennifer Cohen today, who I'll introduce in just a moment. What I'd like to do is to go ahead and take you through our agenda for the day. So let me. So, starting with the welcome, I'd like to just share, as the founder and managing attorney of the Clark-Esposito law firm, what we do here is we help companies who buy and sell goods with other countries. And so we work with companies who are importing, we help them with exporting, whether licenses are needed or a problem comes up with customs and a shipment is held, or they want the goods back at the port, what have you. We're here, anytime a problem comes up. So we're going to continue on with introductions. I'll be introducing Jen. Then we'll proceed with our interview questions. And then following that, we have a bonus to share with all of you who have joined us today. And then we closing remarks at the end. We ask that if you have questions, you go ahead and put them in the chat. Gina from our office will be helping to moderate the Q&A at the end. So I'll be bringing her back on to give us a hand with that. And I also wanted to mention that this recording will be available on our YouTube channel, which is at YouTube on Clark-Esposito Law Firm. And you'll also find there our video library with other helpful videos. We have over 100 of them now relating to importing, exporting, good business practices, among other topics. So you can find that information there. So it's my pleasure to introduce Jennifer Cohen. She's with this amazing company, Citrin Cooperman. They're based in Midtown Manhattan in New York City, over in Rockefeller Center. And she is a partner in the Valuation Advisory Services practice. She brings more than 10 years of experience providing valuation consulting services for a variety of purposes, including litigation support, corporate planning, estate and gift tax planning, mergers and acquisitions, and financial reporting. She provides these services to individuals and companies in a wide range of industries, including healthcare, technology, cannabis, along with automobile dealerships. We had been talking a little bit earlier just about how she works with a lot of manufacturers, distributors, and importers, including, in clothing, wearing apparel, textiles, wine, seafood, foodstuffs, consumer goods, you name it. So Jen's covered the gamut, and I'm really excited to have her with us today. Let me see here. All right. So with that, Jen, I want to welcome you. And, how are you doing today?
I'm great. Thanks so much for having me today, Deanna. I wanted to share just a quick story before we get into my interview that I think sort of relates to what we're going to talk about. And, in the past couple of months, a lot of my clients have come to me saying, Jen, I'm at a crossroads. What do I do with my business? I'm getting older. I don't know if my kids really want anything to do with this business. Should I sell it? Should I just let it go? Should I prime someone else to take over for me? What do you think? The answer to that question really depends on what the business owner wants for the legacy of their business. Some business owners are transitioning to ESOP, which is a employee stock ownership plan, where basically they transfer the ownership to their employees. Some business owners just want to exit at the best price possible, and that might be with a strategic buyer, maybe a competitor who has been eyeing you and likes what you do and wants to add your services into their repertoire, or maybe it's a private equity buyer who a financial buyer who would help you maximize that exit price. And so today we're going to talk a little bit about valuing manufacturing and distribution businesses. And it's important with what we talk about for the business owners to think about these things when they're getting ready for a sale.
Absolutely. And I'll tell you, we've had different clients come to us and say, hey, we're thinking we want to do this. What do you think about this? And it's like, well, hang on, what do you really want to do? And it's, oh, well, actually, we want to go to Florida and retire. Okay, well, then let's talk about how do we get you to sell your business? What steps do you need to do in order to sell your business instead of tackling XYZ issue that you thought you wanted to resolve? And, with them being manufacturers and distributors oftentimes, let's dive into the questions here. How are manufacturing and distributing businesses typically valued?
Sure. So in business valuation, there are three approaches to value a business. It doesn't matter if that business is manufacturing a distributor or if they're a restaurant or a gas station, whatever it may be, there's always three ways to value a business. So the ways you value a business are called the income approach, the asset approach, and the market approach. So the asset approach is basically based on the balance sheet of the business. It's where you're looking at, you're taking the value of the business and it's approximated as the value of both the tangible and intangible assets on the balance sheet, less any liabilities. That value is typically what we call the floor value. And so the value of your M&D business could not be less than sort of your net equity value after you recast certain things, you normalize certain things to their fair market value. So for example, your inventory may be stated at cost. You might use LIFO, which is last in, first out, or FIFO, which is first in, first out. But you would take a look at your inventory and come up with what you think is the fair market value of that inventory. What could you sell it for quickly? Same thing, same idea with equipment, property, plant, and equipment. The number on your balance sheet sort of just represents the cost of that piece of equipment less any depreciation. It doesn't necessarily mean that's the fair market value of that asset. So after you look at all the assets and liabilities on the balance sheet at their fair market value, you can determine the value of the business under the asset approach, which again is typically the floor value of the company. The next approach is the income approach. So in the income approach, you are forecasting the future cash flows of the business and discounting those cash flows at a risk-adjusted rate of return. And a valuation specialist like myself is really taking a close eye on what are the risks associated with the cash flows of the business, which also includes the risks of the industry. So as we know, there are certain risks that are inherent in manufacturing and distributing businesses that might not be the same risks that, a gas station might have issues with. So we'll look at the cash flows of the business, usually for a 3 to 5 year period in the future, and then discount those cash flows back. And the third approach is the market approach. And this is probably what most people are familiar with. And the market approach is looking at, it's basically based on the economic principle of substitution. So you're looking at comparables, either publicly traded comparables or transactions of private companies or possibly public companies buying private companies. And what multiples did those businesses get bought or sold for? And that can imply a value for your manufacturing and distribution business. Typically, the valuation of an M&D business would be based on some combination of the income and the asset approach, because the income and the market approach, since like I said, the asset approach is typically the floor value. But there are certainly some manufacturers that have very specific niche pieces of equipment that could actually be worth a lot of money. And it's possible that the value of that equipment is actually exceeds the value of the cash flows of the business in the future. So just something that, you need to hire the right people to help you understand what's the potential value of the business under each approach, and then sort of come up with that singular value.
This is actually what I was thinking. It's like, all right, there's three approaches. Who decides on the approach? Because, I've talked to different business owners and, it's like, okay, I'm thinking about selling. Here's what I've seen so-and-so company or such and such business go for. So I figure mine must be around that amount, kind of a thing. And so, but it's like, oh, but wait, there's more. There's this other approach with, market, asset, income, is it ever the case that there's a combination of the three that
Absolutely.
leads to it? There is.
Yeah,
okay.
It's almost always a combination. You'll sort of weight the approaches based on which you think is best. I mean, typically an income approach would be weighted more, because what the buyer really cares about is what cash flows can they extract from that business going forward. How are they going to make money once they take over this business? So that's why they're concerned with the income approach. A seller typically thinks about their business in terms of that multiple under the market approach. The problem with that is you may think you're comparable to the business down the street that just sold for 10 times revenue, but are you really? And so that's why you need to do these approaches in tandem to see how the values sort of shake out and see if that multiple even makes sense.
In discussion, do you sit in on discussions when that sales conversation is had, let's say with, private equity or whatever? Is it common to invite you to come in and sort of help explain, or not really?
Yeah,
sometimes the buying party has their own people, or
yeah, exactly. So typically both sides have their own professionals who are helping sort of with the sales process, and we'll do a valuation for one side, someone will do a valuation for the other side, and sometimes we both get into a room with each other and we say, all right, we're really far apart. What are our assumptions? Why are we so far apart? And what do we really think this business is worth? And we get to the right answer ultimately.
Curious, if you could give a range of time, from the hi, I think I want to sell my business, to cool, we're selling the business tomorrow. Is it typically like 60 to 90 days?
Yeah, that's a great question. I think part of it depends on sort of your books and records and how you maintain your books and records. It's really important to maintain clear and concise books and records, that if someone were to audit you, or if a due diligence firm were to come in from the potential buyer and look at your books and records, they can sort of follow everything and say, yes, this company reports EBITDA of X and EBITDA is truly X. The companies that have the cleaner type books, they're the ones that can get through a transaction faster. The ones that are just kind of doing things willy-nilly, maybe they have a part-time bookkeeper that's not paying close attention to things. It's going to take longer for a transaction to close because the buyer needs to get comfort on what they're actually buying. I think that, in a good scenario, maybe you can get through it in like 3 to 4 months. But, there's clients of mine that start sort of their LOI process, the letter of intent process, and they don't get a transaction closed for a year, over a year. So it depends.
And just to clarify, I know we're going to get to it, but this EBITDA, could you just describe what that is and what that stands for, please?
Sure. So EBITDA is earnings before interest, taxes, depreciation, and amortization. It's sort of similar to the profit of the business. It's just not including those certain things that I mentioned. And maybe I can answer already the next question that you were going to ask me, which was on what basis are M&D businesses typically sold? And the basis is typically either EBITDA or something called seller's discretionary earnings. And that is basically your EBITDA, and you add back in compensation paid to owners. So typically when business brokers are going out and selling or marketing a business, an M&D business for sale, they'll sort of quote it in terms of a multiple of EBITDA or SD&E. Which is really just the market approach in a nutshell. And I always like to caution my clients that they shouldn't rely solely on the market approach, because sometimes it doesn't tell the whole story, especially when you have a very niche business where true comparables just don't exist. You want to look at the cash flows and the income approach as well.
If we could just step aside from the number crunching. I've heard, hey, we have, our reputation is such and such, and in particular in these sectors, or it's, we have this many followers and we've been tracking the metrics and we know that business comes through this channel, Or we have this influencer who gives a lot of value to the company. Like, what about the subjective, non-numerical things?
Yeah,
Do those add
those,
value also? How do you quantify
yes.
those?
Well, that's a great question. There is no scientific way to quantify that. However, in valuation, like I mentioned earlier when I was talking about the income approach, there's this risk-adjusted rate of return. And so in there, you need to think about both the positive factors and the negative factors that may impact the business and sort of combine them into this one, what we call a discount rate. And so positive things may be that they have a contract with an influencer to do X amount of advertising per year, or all those things that you mentioned would be on the positive side. And then obviously there are things on the negative side, and it sort of all gets into this sort of black box of what is the appropriate risk-adjusted rate of return. And the lower that rate, the higher the value of your business. So if you have more positives than negative that are influencing your business, you'll have a lower discount rate and a higher value, all else being equal.
Right. And what if there are like variable factors that could be changed? Let's say somebody, I don't know, somebody on the board of directors has become somebody in the media, and we really don't want to be associated with them anymore. But, contractually, they're locked in for a certain number of years. Is there ever valuation based on if this person were removed, or if that thing changed versus if it stayed the same?
Yeah, absolutely. In valuation, there are what we call standards of value, which is basically just different definitions of value. So typically people are familiar with what's called fair market value, and that's an IRS concept or definition of value, which basically contemplates a hypothetical buyer and a hypothetical seller. But if you're in this world where you know who the buyer and seller are, you can do a valuation under what's called synergistic value. And so you can take into consideration synergies between the two businesses. And maybe one of those things is getting rid of someone on the board. And then you have to decide how is that going to impact your cash flows, hopefully positively. And you'll come up with sort of the synergistic value of the business, which just means the value to a specific person or specific buyer.
Got it. And by the way, on this topic of comparable, right, looking at comparable companies, have you ever had it where you sit down with the other side's, due diligence, or maybe they have their own valuation company, and it's, this is the value we see for XYZ, and they're like, yeah, we're not seeing it that way. And if you're looking at comparable companies, and it's like, why did you choose the companies you chose? Or why wouldn't both of the companies have chosen the same companies as comparables?
Yeah, that happens all the time. Obviously, as appraisers, we have certain databases that we can use, and also we just have access to the global internet to sort of do our research on what is comparable. Also, I always just straight up ask my client, are there other businesses that you believe are comparable to yours? And if they give me a subset of companies, I'll look them up, see if they've ever done any transactions with other businesses, etc. But especially when you're dealing with more niche businesses, you have to sort of cast a wider net to come up with those comparables. And your net might not be as wide as someone else's net. And so you might capture a really broad range of transactions, and the other side may have little to none. So there definitely is, I always like to say valuation is an art, not a science. So two people can look at the same business and come up with a different value because it's not a scientific method. There are certain inputs that take sort of analyst judgment into consideration. And so at the end of the day, it's as an appraiser, you need to do what you think is right and what you feel is comparable. And then you have to be able to defend that.
And how often do you find that the companies, your clients say, hey, these are comparable, are in your opinion actually comparable?
Yeah,
80% of the time or not
yeah,
really?
they're usually pretty spot on. The problem is what happens is the companies say, oh, yeah, my buddy just sold his business in Idaho and they kind of do the same thing as us. Well, the problem is that was a private transaction. They're not sharing the details with the world of that transaction. So even if you know of comparable companies, it doesn't mean you can get metrics out of those companies to infer a value for your client.
Okay. And so how does that work with, then smaller, closely held companies?
Yeah, I mean, so part of the market approach is we have what's called the guideline public company method, which is looking at publicly traded companies that might be similar. And if we're talking about a really small mom and pop shop, even if a public company does the exact same thing as them, it might not be a great comparable because they're just
Right.
so massive in comparison to this mom and pop shop. And there are ways to sort of adjust the multiples downward based on size and based on profitability. But at the end of the day, it might just be too small of a company to be comparing to someone who's public.
And, thinking about the basis on which they're sold, how much weight is given to how long a company has been in existence? Or is it that it's good if you're a startup and there's this potential, and so private equity will take you, or venture capital, or no, it's good you've been around this long because the historical data says you're probably not going anywhere anytime soon?
Yeah, I think one of the important things about those businesses that have been around forever is they need to make sure that they have a succession plan. So, if it's a family business that's been, it's now on its fourth generation, but they don't have that fifth generation up and coming, just because you've been around for a while, if you don't have an experienced management team who can step in and take over at any time, the value of your business might not necessarily be as much as it could be. And then on the opposite side with startups, you have to have a proven concept. And a startup is definitely trickier to value than an established company, but there are ways to look at it. And especially when you're forecasting these future cash flows with startups, you're going to see really, really high growth rates in the beginning because obviously they're just starting up. And so to offset the risk of those projections, you'll probably be dealing with a much higher discount rate than you would with your, business that's been in there for, 4 generations.
And with those businesses that have been around for several generations, or even just now it's heading down to my daughter and son, kind of a thing. How far in advance would you recommend they come to you to start making sense of, what could be the basis? What can we improve over the next, I don't know, however, time frame? Like, do
Yeah.
you do that work also?
Yeah. I
Okay,
mean,
this is 2030 forecasted to,
yeah. I mean, at Citrin Cooperman, we have a dedicated manufacturing and distribution practice. And outside of the valuation aspects of it, we can help clients with sort of their costs and their inventory and, keeping the books clean so that they're ready for that transaction. And in valuation, a lot of times clients will come to me and say, Jen, I think I want to sell my business, but I actually have no idea what I would sell it for. And so we'll start out and we'll do a calculation and say, hey, look, here's sort of the range of the fair market value of this business. And then we can give the business owners, some pain points of where maybe if they cleaned this up or they did this, that value could increase. And sometimes that same business owner will come back to me a year later and say, hey, Jen, I did what you said. Can you now do the valuation now? And can we see how it's changed? And if they've made the right changes, we can see that improvement in the valuation.
excellent. So let's go on to the next question then. What are some important things to keep in mind for business owners looking to sell their manufacturing and distribution business?
Sure. So I already mentioned sort of keeping a deep bench of experienced managers. That's really important because typically when there's going to be a transaction, the new owners don't want to keep the old owners on board for too long. Maybe there'll be a transition period of maybe 1, 2, 3 years, and maybe there'll be some sort of earnout that's tied to the performance of the business over those few years. But after that, typically the old owners sort of disappear, and now the new life of the business is started. And so you want to make sure you have those experienced managers that know how the business operates and they know all the ins and outs so that there's no disruption in the business. Another thing that M&D businesses should keep in mind is you want to constantly be researching technology and employing the best technology you can. And artificial intelligence is here. I don't think it's really going anywhere. And so there are a lot of ways that manufacturing and distribution businesses can improve some of their efficiencies with AI. And I think it's just important for people to keep on top of what's going on sort of in tech that's related to these M&D businesses. And the more tech friendly the business is, it's a positive for the sale of the company.
Yeah. Okay. But in looking at, I'm thinking about our clients who are manufacturers, and there's the physical plant, and, making changes to that are expensive. And okay, now I have to deal with this other state regulatory body to get this license. Oh, but then the county wants something else. Oh, and then the city wants something else. How is employing technology in the physical plant perspective in that context? How can that be done, if you have any ideas?
Yeah, I mean, I just think that in terms of keeping track of inventory or keeping better track of inventory, there's a lot of technology that can help with that. Yeah, I think mostly on the inventory side is where technology can be helpful. I mean, whatever you're sort of manufacturing, you have some sort of machine for that, and it's unlikely that technology is going to replace however that widget is made. But from getting that widget from the plant to the customer's house or whatever it may be, I think there are certain technological processes that can be implemented in between to keep track of where the widget is in the process and sort of how it gets to its end user.
What about parties in the supply chain? If they're manufacturing, and then, because I know from talking with some clients, it's, here's what we're doing, and we have this distribution network that our competitors don't have. Would we also be looking at technologies used by those entities in our supply chain?
Yeah, and I think one thing about the supply chain that's really important is don't be dependent on one single source, because you never know what's going to happen. I mean, what if there's a plant fire at that supplier and then tomorrow you have no one to make your product? I think, I'm not sure how necessarily technology plays into that, but just the fact that the supply chain is super important and you have to have many suppliers that can do the same thing so that you're not dependent on one single source.
As we're talking about the supply chain, some questions have come to mind just in relation to what U.S. Customs is doing right now with their attempt to track the supply chain going back, not just from the first level, but going back. A lot of manufacturers obviously import their inputs, right, so that they can manufacture things. Is sort of this regulatory compliance piece where, let's say, I know in some industries, and Customs sort of wants it for everybody, but something called a social compliance program.
Yeah, ESG, right?
And ESG, and California has its supply chain, so it's like, to what extent is the value increased for having it or decreased for not having, these regulatory pieces in place, if at all?
Yeah, I think a potential buyer is going to do a lot of due diligence before they make their purchase of said business. And one of the things they're going to look into heavily is regulatory compliance. And so if you have a good track record of, doing what you need to do, like you explained, you're tracking your imports basically from seed to sale, that is a positive. And if you are just completely disregarding all regulatory issues and just kind of going willy-nilly, then you're not going to look as attractive to a potential buyer.
Thing about sales, it's companies can have a large client or a few large clients. And I'm just thinking about, in terms of valuation, is it risky to have one client? I know it's risky, right? But
Yeah.
okay, well, 80% of our sales go to, big box store, which shall
Yeah, I was
remain
actually going to give that
unnamed.
example too. Like if you think about a clothing manufacturer and distributor, maybe they're selling all their clothes to Target or Walmart or something like that.
Yeah.
It depends on if there are contracts in place that sort of shield the business and guarantee some certain minimum product distribution. But in general, having 80% reliance on one customer is a negative. And sort of when we talk about that risk adjusted rate of return, that discount rate, part of that black box component of the risks, customer concentration is key. And so typically an appraiser like myself will ask their client, can you provide a list of your top 10 customers and the percentage of sales that are related to each? And if they have audited financial statements, they'll have to disclose that customer concentration in the financials. Some businesses don't need audited financials, so we'll ask the client to give us that list so we can assess, is there a heavy reliance on one single customer or two or three maybe? And how does that impact the business if that customer were to disappear for some reason?
And yeah, because I keep looking over at the question, like important things to keep in mind for business owners looking to sell their manufacturing and distribution businesses. How is it that companies who want to sell have engaged in exporting, who've increased sales through selling overseas? Is that something you commonly see or not so much of?
Not so much. I think e-commerce is what we're seeing mostly now. It's that they're trying to extend their business and increase their sales via e-commerce and selling online, and sort of the strength of their e-commerce platform is important to think about when they're looking to sell. Like, are the logistics there to make that happen?
And when the buying company is looking over the data, yeah, I would imagine, for some industries, there will be a dip in 2020 and 2021, in part because of all of the global supply chain issues, getting the inputs to actually do the manufacturing. Is it that it's, oh, okay, you have this dip, but it's okay because the globe, was dealing with this pandemic? Or typically it's, okay, this was happening, but what happened to you? Why,
Right.
why did this happen? Is there that dialogue there, or?
There, yeah, 100% there's that dialogue. One thing to note is that valuation is always forward looking. So while we look at the past and the historical results of the business, when you're doing a valuation, you're really thinking about the future as of a specific date and time, or as of your valuation date. So we do usually look at the last 5 years of historical performance if the business has been around for that long. Obviously, COVID is in that purview at this point. And so we'll take a look and we'll also see, like, have they recovered? If they haven't recovered, why? What's driving, or what's happening that's not allowing them to recover to their pre-pandemic levels? So whether they're sort of recovering or not will flow into that income approach and the future cash flows of the business and how we think those might look.
Now, I know New York State has some zones, and they've got some in particular upstate, where a manufacturer can move there and get preferential tax treatment for 10 years, right?
Mm-hmm. Yep.
Where there is a company who is in one of those, is it important to the buyer that there's some type of business succession plan, tax succession plan, for example, to know, okay, well, you're here now. What were you thinking about when this ends? Are we now moving to another state, or is it sort of that's your problem? You deal with it, buying party.
Yeah, no, I think that's important to think about. I'm not sure exactly of the legalities of if you transfer ownership in that business and you had that sort of tax break, does that transfer over to the new owner of the business? I'm not sure how that works, but
Assuming it did, that
yeah,
the entity has it and it carries forward.
yeah, so assuming it did, you can sort of model that tax benefit into your future cash flows. And then at some point, you'll need to get to a place where you have what's called normalized cash flows, where you are paying taxes at full free. And so that's how you'll sort of model out the cash flows to get to the value of the business. And it's important to know, is the business going to stay there or is it going to move? Because that could change the tax treatment.
Now, coming from the seller side, is it ever the case where they're evaluating a buyer and, we're talking about heavily regulated industries. You talked about cannabis, so even taking that as an example, okay, you're a grower. Well, you need to renew the license. Well, we foresee there could be a problem with the license renewal because of such and such. I'm bringing this up because if the existing owners, when they sell, you mentioned this transition period, is the buyer looking also to hang on, if I'm getting some payment as a result of performance post-sale, are they then evaluating what risks may exist on the other side where those sales may not be realized?
Yes, they are looking at that. And sometimes buyers and sellers will set up an escrow account so that if something negative happens in the future, like maybe you find out a year in that the prior owner didn't properly file their tax returns, or they didn't, properly, import their product, and they just skipped past customs somehow. And now all of a sudden there's a huge lawsuit on their hands. And they weren't even the ones to sort of create that problem. A lot of times they'll set up this escrow fund that comes out of the proceeds that the business owner can't touch until a certain amount of time has elapsed, just to cover any of those sort of phantom liabilities that might come up in the future.
And so it's not necessarily the case that income tax records are even looked at, or
oh no, they are. But there's a possibility that they took a position on their tax returns that later gets audited by the IRS, and the IRS doesn't agree with it, and there's taxes and penalties, etc. So yeah, very much you're looking at all the financial records of the company, including their tax returns. So you should know up front if they filed, but it's possible that there's some discrepancy and the IRS just doesn't approve of it.
And how often is it that a company will come to you and they actually have, clean and concise, books and records that you can actually work with without any cleanup?
I mean,
10%?
Yeah, I was gonna say it's not often. I think, we're working with small to medium sized businesses, and
what does that mean? What does that mean to you, small to medium size?
Probably under $50 million of revenue. But while they're great at whatever they do, they're maybe not so great at finance. And so that sort of falls to the wayside. And now all of a sudden they're like, hey, we want to sell our business. And we're like, okay, let's see your books and records. And you're like, none of this makes sense. This doesn't reconcile. This doesn't tie to this. And you sort of have to step back and sort of recreate everything to get to a point where you can finally assess what you think the value of the business is.
And have you ever had it be the case where, based on that work that you do, that it's, hey, we need to, file an amendment to the tax return, or something with customs, you need to go find a customs attorney, and you probably should amend the customs entries, they're called?
Yeah, I mean, we've definitely had it where we think, maybe the client should amend their returns. maybe they didn't pick up certain expenses, maybe the method of the way that they were doing their accounting is just wrong. So yeah, that certainly happens.
Just, generally, any other important thing to keep in mind, because what's running through my mind is sort of, oh, what else should we be thinking about,
Sure. Yeah, I think working capital is a really big thing. So, I mean, working capital just means your current assets minus your current liabilities. So, sort of like what kind of reserve do you have that's fairly liquid? And in every transaction, there's going to be a target working capital amount, and it's typically some percentage of revenue. Let's just say it's 10% of revenue. That means that when you go to sell your business on that given day, your balance sheet needs to have 10% of its revenues in working capital. And if it doesn't, there'll be sort of a penalty where you have to make up for that working capital deficit, and you'll lose out on some of the proceeds from your sale. So if you're diligently looking at your working capital and making sure you have a solid working capital reserve, you won't get into a position where at closing day, you're not delivering what you're supposed to. Another thing to think about is plant capacity. Nobody wants to buy a business that's at 90% plant capacity because they have no room to grow. So while it might be great for the current owners, they're at 90% capacity, they have their workforce all set and they're just churning out the product. That might not be a good fit for certain buyers because typically buyers want to buy something that they can grow.
Sure. No, absolutely. And this working capital, or a reserve, should that just be in a separate bank account, or where would that be found?
It doesn't really have to be in a separate bank account. I mean, it's just that you need someone to sort of be tracking the working capital and so sort of keeping tabs on your cash, your AR, your inventory, your accounts payable, just to make sure that that reserve exists and you're not sort of working at a deficit.
Got it. All right. Well, moving on to the next question. What factors impact the value of a manufacturing and distribution business?
Yeah, so we've already touched on a couple of points. Key person risk is a big one. What that means is if you have an owner who's doing everything from sales to finance to operations to HR, and they're the man or they're the person in charge, that doesn't look great when you're going to sell your business, because what happens if that person's not working there? They have all the knowledge, they have all the customer relationships. So that's what we call key person risk. That's going to impact the value of the business negatively. And that goes back to having a deep bench of experienced managers to offset that risk. Another thing we talked about is customer concentration and supplier concentration as well. If you're highly concentrated in your sales to one or a couple customers, or if you're making purchases of your supplies from, one or very few suppliers, that's going to have a negative impact on the value of the business. Also, just the length and stability of your customer relationships. The longer you've been in business with the customers, the better it looks. Another thing to think about is the age of the labor force, and is there even access to skilled labor? Some markets, it's really tough to find quality workers. And if you have an aging labor force, a buyer might come in and say, these people are all going to retire in the next 2 to 3 years. And then what am I going to do? And if there's not great access to future skilled labor, then maybe that's not a good fit for them. Also, thinking about sort of just the geographic and aesthetic desirability of the location. Are you located near your customer? Is your plant located near your end customers? How far do you need to ship the product? Are you easy to access? So those are other things that might come into play.
Interesting. Yeah. Yesterday I had lunch with a client of ours, and he was talking about Walmart and Bentonville, Arkansas, and how a lot of the key companies who sell to Walmart are right there. They all have a presence right there in one of the counties nearby, so that they can always be in regular communication.
Right. Exactly.
Which is refreshing that people will meet in person, today.
Yeah.
in this day and age. that you mentioned, you're working with smaller companies, 50 million and under. Um, when we're thinking about having experienced managers, how many are we really talking about? So, the owners started it, and there's a lot of family businesses, they can get to 50 million and they don't need a ton of other, so-called experienced managers. But is there a number that looks appropriate or looks good to have,
Yeah, I
kind
mean,
of thing?
it definitely depends on the size of the business, but I think you want at least sort of 2 to 3 people that have sort of full knowledge of the business operations outside of the owner. You want to have those people that do not have equity ownership, but understand and they're fully capable of sort of keeping the business afloat if the owner were to disappear for some reason. The larger the company, the more people that you should have, the bigger the C-suite. But in those smaller companies, if you have at least, 2 people outside of the ownership and the family, you're in much better shape than a lot of companies.
Okay, but then what about this, I'll call it a conundrum, maybe it isn't, but, this idea of, well, if the workforce is older in your company, how does one have that
Yeah,
knowledge and then they're 25,
right.
I mean,
Yeah, it's definitely a balance of having sort of workers at every stage of sort of their career and their life cycle. You need your entry level staff to be able to perform sort of menial tasks at a lower wage rate, but then you also need your VPs and your C-suites to oversee everything and make sure everything keeps moving. And yeah, I mean, it's a balancing act, right? And I don't know that there's any right or wrong answer to how many people do you need or how old should the workforce be. It's just something to keep in mind, especially as you go into the market and try to sell your business. If your workforce is just highly concentrated in, the 50 to 60-year-old age bracket.
I was thinking, is there a so-called right blend, so where it's maybe 30% is older, I guess, if,
Yeah.
and whatever that means, I don't even know, over 45, and then the other 70% or 60-40. Like, have you, in your experience seen, oh, this is a favorable blend or to a
No,
buy?
I mean, every business is different. It's just so hard to sort of kind of put a percentage out there. I think it's very dependent on the work that's being done, the product that's being sold, locate everything, comes into consideration when you're thinking about that. So it's hard to just pinpoint a certain percentage.
Sure. That makes sense. I figured I'd ask anyway.
Oh, yeah, it's a fair question.
So, before we get into the Q&A, just to share a couple of things. We do have a bonus for anybody attending today or anybody watching this on, our YouTube channel or somewhere else. We've got a tip sheet here on valuing and selling your manufacturing and distribution business. So that'll be sent out to everybody who is attending. And of course, if you didn't or don't receive it, you can always send over an email, to contact@clark-esposito.com. That's at the bottom of all of our slides here. And I know Jen's got an exciting event coming up. Let you talk about that, Jen.
Yeah, so as I mentioned before, Citrin Cooperman has a dedicated manufacturing and distribution practice, and some of the practice leaders are putting together a webinar coming up on November 13th from 11 to 12 p.m. It's called Navigating the Future, Strategic Planning for Manufacturers and Distributors. So if that's something that you're interested in, feel free to contact me and I will connect you with the right people so that you can attend, and attendance is free.
And here is her contact information here. So J. Cohen at citrincooperman.com or by telephone, of course. Jen, what's the best way to reach you? Is it telephone?
Yeah, best way to
email?
reach me would be email. Nowadays, work from home, you never know where I'm going to be. So email is always the best way to reach me.
Okay, excellent. And so, with that, let's bring Gina back on and we can start with the Q&A. again, if anybody has questions, you can go ahead and put them in the chat.
All right. So our first question is, what are some of the challenges that M&D businesses faced in 2024?
That's a great question. There were a lot of challenges for M&D businesses, and I think the high cost of capital and the interest rate environment were probably one of the biggest challenges. And that led some companies to either delaying purchases of equipment upgrades or other necessary purchases. We're now seeing the interest rates come down a little bit. The Fed has talked about potentially further reducing interest rates. So just something to keep an eye on, but that did have quite an impact on the M&D sector this year.
Okay, and then we had another question. What are some disadvantages to operating a business in M&D versus other sectors?
Yeah, so one of the disadvantages would be that there's very high fixed costs in manufacturing and distribution. You need to have a plant, you need to have a lot of equipment, and that all those things can be very costly, as opposed to other sectors where you can just have a laptop and work at home and have very little fixed costs. Also, regulation. Obviously, we have Deanna here who knows all about the regulation in the industry. But just complying with that regulation, it's tough and it's costly for businesses, but it's very important. And I would say that this industry has a higher level of regulation than others. Also dealing with unions, not every industry has to deal with union workers. There's pluses and minuses to unions, but that's just something that might differentiate the M&D sector from others. Also, the rise of foreign competition, I think that's huge. Sometimes some products and some items can be manufactured cheaper and then exported into the United States and then sold by foreign companies and sort of take away that business from our onshore manufacturers and distributors. And that's something that's been happening for a while and continues to happen. And lastly, I think some products are just being commoditized, depending on what you're manufacturing, and sort of the more these products get commoditized, the more pressure there is on pricing and the price point of the products, and it might sort of depress margins in the industry.
They commoditize?
Yeah, like becoming a commodity, like, you could just, there's no differentiation between, seller A and seller B. So you're just going to go pick the cheapest one because they're basically exactly the same.
Is there a strategy then to selling the business? Like, okay, interest rates are really high, so let's plan
I think you just need to get the right advisors on your team. There's a lot of due diligence that goes into buying and selling businesses, both on the buyer side and the seller side. So you want to make sure that you have the best team possible on your side. Attorneys are very important in the process, in drafting contracts and reviewing contracts. And I think that to position yourself in the best place to sell your business, you need to have the right people on your side.
Does it hurt a company if they had tried to sell it before and nobody bought it? Or is that public information? Or
it's not typically public information, so I don't think that necessarily hurts. Unless you're dealing with a public company, you don't really have to disclose much information. So it probably wouldn't even be known unless the business owners were out there, talking about it a lot.
Well, and should business owners be out there trying, hey, I want to sell my company, I want to sell, or is that normally a quiet thing?
No, I think if that's your desire and you want to sell your business, you should, talk to as many people as possible, business brokers, investment bankers, attorneys, competitors. Competitors can be a great fit for buying your company. They're going to eliminate maybe their biggest competitor, and so they're willing to pay a premium to do that. So I don't think there's any shame in sort of speaking it into existence if you're looking to sell your business.
Sure, sure. Gina, are there other questions?
No, no other questions.
So Jen, I just, any final takeaway for the audience here?
Yeah, I know I gave you guys a lot of information to think about. Business valuation, while it may seem easy, there's only 3 ways to do it. It's actually very complicated, despite how I may have described it. And again, just having the advisors, the best advisors on your side when you're getting ready to sell a business is the most important. And so if you ever have any questions about valuation or what can you do to make your business look more saleable, feel free to contact me.
Excellent. Well, Jen, thank you so much for joining us today for our town hall. And thanks everybody who joined us. We look forward to hearing from any of you, whether directly to Jen or to our office as well. Thanks again. Bye-bye.
Thank you, everyone.
Bye.
Subscribe and click the bell icon so you'll be the first to know when we upload a new video. Check out our playlist if you want to see more of our videos, and comment below and introduce yourself. We'll see you soon.